name's David Floyd. I am the guest analyst this month at Eightcap Trade Zone. Happy to be here. I've been providing a weekly video that goes out on Sundays that kind of gives you a sense of what I'm looking at ahead for the week. Then we convene on Wednesday for me, Thursday for those of you in Asia, where we kind of talk about what happened. You know, what was I looking for? Did it play out? And more importantly, what do we expect for the rest of the week? Also, most importantly, I want to address your questions. I'm really interested in having people understand how I approach the markets so that you too can either follow along and or implement it in your own trading. Now, for many of you that are viewing these videos and coming to these webinars, you're also taking a 2-week trial to our entry-level service, which is the daily market forecast, which comes out basically right on the Asian opening. I publish it after the New York close. And what it basically does is it gives a snapshot of what I'm looking for in terms of a directional bias of the major asset classes over the next 12 to 24 hours and some of the key levels that you're going to want to be looking for to determine trade entries and trade exits. So that's enough of the kind of the intro, but I think it's important to give you a sense of who I am, what I'm here to do, and what my goal is in terms of accomplishing during this next half hour. The biggest thing I would like from you folks, though, is for me not just to be talking to the camera for half an hour. I would really much rather answer your questions. That creates a learning environment as opposed to me just kind of talking to you. I already understand this stuff. I don't need to talk to myself to do this. I want to have an engagement. I want to walk away knowing that, you know, X number of people had their questions answered and they're walking away going, that could be helpful. And now I see how I could implement that in my own trading. So I encourage you, just pop the questions into the question box there, and I will get to them. So I'm going to start off today with the Aussie dollar. I'm going to go through a whole series of markets today. But what I'm going to start off with first are the horizontal lines that are drawn on the chart. They're like any other support and resistance line that you've probably seen. Support and resistance lines can be drawn, you know, manually, which means there's a degree of subjectivity. You know, somebody may say, you know what, I'm going to draw a trend line from here across this peak, and then when that trend line's broken, I'll know that the downtrend is over and we're resuming the uptrend. Or maybe you're drawing the trend line across, you know, a series of lower lows or a series of lows, a series of highs. Trend lines have been around in terms of classical technical analysis for, you know, probably over 100 years, maybe even a little bit longer. And they probably work. I've never back tested them because, again, support and resistance done the classical way is subject to the practitioner's interpretation of using them. And that's where I think a lot of technical analysis falls short. The support and resistance lines you see on my charts are all mathematically calculated. I'm not coming in and saying, oh, that looks like a good place to draw on the purple dash line. I'm going to draw on the red one here. These are all support and resistance lines that are done based on volume, price action, time, frequency, and a couple of other things. I keep my hands out of it. I came up with the algorithm or the equation to do it. Then I let the computer take care of the rest. The reason I did it this way was really quite simple, and I'm going to explain why we use them in the way we do. I'm trying to isolate areas in the marketplace where everybody else, or at least not everybody, because that would be a gross not miscalculation. That would be an incorrect statement. I have identified levels where a large number of market participants are going to be looking. Therefore, there's going to be a reaction from those levels. So like I said to a client last night who sent me an email saying, hey, I'm trying to get a handle on using these levels. And I basically said, it's really simple. Support is support until proven otherwise. Resistance is resistance until proven otherwise. So when prices are approaching a level from above, that's a support level. When prices are approaching prices from below, that's a resistance level. And what I've done is I have 4 sets of lines here. Each set of lines has a support and resistance. It's basically 2 lines. So wherever prices are relative to those 2 lines is determines whether or not it's a support or resistance level. I've calculated 4 sets of these lines based on time frames: short term, medium to long term, and then long term. The purple ones are the longest term lines. Therefore, they're going to be the most significant. They don't come into play very often, but when they do, the market will typically respect that level. This purple line here was definitely here back on these days. I did not draw this in after the fact. The green lines are going to be updated more frequently. They're going to come into play more often. Therefore, they're going to be more shorter term in nature. You're going to get a lot of reaction from them, but the durability of them may not be quite the same, meaning that the reaction to it may be excellent from a day trading or intraday perspective, but an investor is not going to look at that and go, you know what, that's a meaningful level. I'm going to position my portfolio or position my long-term holdings based on that. So purple is the most significant. Green is the, I don't want to say least significant because they're all significant. And then orange is the next one up, and then red. So it's green, orange, red, purple. So enough about that, but I want to show you how they work and how you can incorporate them into your trading. So last week, for those of you that were on the webinar, we had a level in the Aussie dollar of 70.04. That line is no longer there because prices have moved and we readjust the lines. But back at that point in time, 70.04 was a killer line, orange line, so fairly significant. I said if prices get above 70.04, they're moving higher. Well, now they've moved above higher term level, longer term levels as well. So now we're firmly above this whole cluster of support lines. And we're certainly above the orange line, which is the most significant one in terms of the proximity of where prices are. Once prices get above the lower band, in this case, 70.11 or 71.18, the logic is prices should not automatically, but over time, traverse to the other side, which in this case would be up towards 72.76. So anybody who's still long, I don't happen to be long Aussie dollar still, but if you're still long from 70.04, you're looking great. I would probably set my stop below this 71.18 level, maybe, call it 71.10, because if it breaks back below this support level, this orange line right here, in fact, I'm going to blow up this chart just a little bit so you guys can see it a little bit easier. If prices get back below 71.18, I'd probably cut the trade. The first sign that maybe the trade's starting to break down would be if it broke down this support line right here, 71.52. Again, a green level, certainly more shorter term in nature, but if prices break down and hold and continue to move lower, it would almost be a foregone conclusion that 71.18 will get taken out next. But for right now, if you are long the Aussie dollar from better levels, meaning lower levels, I'm expecting prices to traverse back towards 72.76. That could be a few days, it could be a week or two, but that's the logic that prevails. Same thing that happened back here in January 13th. Eventually prices, when they got above the orange level, they traversed ultimately all the way back up. Now, granted, it wasn't an easy ride. In the money, out of the money, in the money, giving some money back. But again, depending on your style of trading, you use the levels the way you see fit. For a longer term swing trader, this is part of what they deal with. They always have to deal with the ebb and flow. And for a day trader or let's say very short-term swing trader, you're looking to fade moves into these. You're looking to short that, expecting a quick rebound lower. You're looking to buy that initial spike back above resistance and then get out fairly quickly. Does that make sense? Because it's really important that you understand the basic concept. Again, the concept's pretty simple. Support is support and resistance is resistance. The other part of the question I got last night was, and I'll just use this as an example. Let's say we're back here in time. Now I'll just scroll over here so that we assume that we're back in time and we don't know any of these bars are here. Just because we're coming up to a resistance level, does that mean I want to get long when it breaks above? And the answer is no, not initially, because we've traveled all this way. Think about it like you're running a marathon and you have to do 26.2 miles. And I'm sorry, I don't know what that is in kilometers. I think it's like 13 or something like that. It's 26.2 miles. So by the time you get to 26.2 miles, you're pretty gassed. If once you got there, somebody said, you know what, the it's now at 28.6 miles. You're like, oh, okay, I can get there, but holy crap, I wasn't planning on that. I don't have much gas in the tank. So more often than not, when these prices get here, you're not looking to buy a breakout. Buying breakouts is probably one of the worst trading strategies out there. What you're looking to do, assuming the market conditions allow for it, is you're looking to fade that level. You've had a big move, now you're coming to a resistance level. And I know that can be really hard to do, but that's what you need to do. Because you'll notice that when they hit these resistance levels, oftentimes they'll rip right back lower. Same here. You buy this, somebody might say, oh, I'm going to sell this Aussie dollar on this break of, 70.82. Well, it worked out for a little bit if you're a nimble trader, but then it came ripping right back through. So it's really important that you treat them as simply as possible. I got a couple questions in here I want to get to, so just bear with me. Hi there, Rick. Yeah, we've been sharing quite a few emails, so hopefully this is all really helpful for you. That out again. All right, Rick's got a question regarding Tesla. So let's just go to Tesla and make it really easy. And here's Rick's question, rather than me reading it back, so everybody can read it. And Rick's a client currently, so the reason he knows these numbers is I've been talking about this in communication with clients. So here, if you look at Tesla, he says you're bearish below 882. That is correct. 882 is a support level. What that means is if it gets below 882, holds it, maybe tries to retest it. So if I use my cursor here, let's say Tesla breaks below 882, holds below there, doesn't immediately pop back, and then maybe has a little rally back up and tests it a little bit and can't get through. And let's say at the same time, the S&Ps are weak, the NASDAQ's weak, and other factors are suggesting that there's a bearish tone to the overall market. Yeah, I'm going to lean in to that 882 resistance. Now support, but then if it breaks below, then it's resistance. I'm going to lean into that and expect that we're now starting a new leg lower. Because like I told you, Rick, support is support until it isn't any longer. Then when the break of that support happens and it's retested and we can't get back above it, you have to make the assumption now that we're now traversing, or there's been a condition shift in the market. We've now gone from a bullish, or let's say neutral Tesla right here, because we've gone nowhere for the most part. We break below here and start not being able to get back above. That's a condition shift. We've gone from neutral to bearish. And then I'm going to be looking to use rallies to get short Tesla. So while 925 and 975 are upside resistance, yeah, if we get up to 973, guess what? I'm going to sell that. Unless there's like some ripping rally that says, the Fed comes out and says, we're not going to raise rates, or, something really stupid that makes the market extremely bullish. But given that Tesla's had such a hard time getting above 973, my first instinct is get short into that level. If it gets above and manages to hold, well, now resistance is now support. So that's how you have to look at them. And it's very basic. The reason these levels are effective is because a lot of other people are looking at these levels. There's a reason when you look at this chart, these levels have been respected. And again, these levels were not drawn in after the fact. You're not going to get that same type of reaction if you're just drawing in your trend lines. And that's not to take away from anybody's ability to be a good technician. But the problem that people have, or the problem we have with classical technical analysis, or analysis of any type for that matter, is if you're the only one, or there's only a handful of people that has the same idea, what does it really matter? Collectively, you need a lot of people buying or selling in order for your idea to play out. Therefore, don't you want to be participating in trades where there's a high likelihood that the market's going to react to it? Of course you do. Of course you do. And I did classical technical analysis for years. I'm 20 plus years into my career. So I got a lot of knowledge up here. I got a lot of experience, but I've done classical technical analysis and it's served me pretty darn well. But there's also a good degree of experience built in there that is a big contributor. So for newer traders that don't have that level of experience yet, I think it's reasonable to assume that if you're just doing classical technical analysis, it's going to be hit and miss, because again, unless the rest of the market agrees or is looking at your levels, your areas that you think are going to provide the catalyst to higher and lower levels, may or may not play out. It may play out just because you're wanting to be long and the market's generally bullish and your stock or whatever you're trading gets dragged along for the ride. I get that. But I don't want to get dragged along for the ride. I want to be in the front freaking seat. I want to get the immediate reaction. I want to get not the move that is a fraction of what the overall market moves. I want the whole move, or I want the ability to play within that whole move. So if I'm doing classical technical analysis here and I draw a trend line in on this Tesla downtrend, I might say, oh, I'm going to get long here because we've broken the uptrend or broken the downtrend. Well, that might work, but I look at this and I'm like, that's a big resistance level. It's been pretty pivotal. Boom, 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 boom. I'm not so sure. And we've got all this price action right here, which is going nowhere in a hurry. So we have an impulsive move down, a correction, which means there's no interest, no aggressive buying, also no aggressive selling either, mind you. But then I've got overhead resistance. Trend line break, who gives a crap? Nobody gives a crap. So therefore, again, it's not to rain on the parade of classical technical analysis. It definitely serves a purpose, but we have to know what the limitations are. And so I just want to go back to Rick's question here. Yeah, and again, 830, Rick, 830 is, wow. I mean, you can't argue the fact that 830. So again, if we got down to 830, would I be a buyer? I might try to be a buyer down there. I mean, I don't trade individual stocks for the most part. I mainly trade FX and futures. But if I was a Tesla trader and I was working within the confines of the support and resistance levels, yeah, I'd probably be a buyer here as opposed to looking to sell the break. Again, depending on what's happening in the market though. I mean, if we come in and suddenly World War III is underway, well, being a buyer at 830 is probably not the best thing. So you adapt to what's happening in the market when prices get to those levels. And again, as I said, Rick, how you use the levels is going to be different than me. If you're a swing trader, you're going to give it more room. You're going to be looking for bigger moves. In terms of me with the S&Ps, I tend to be intraday trading. So I'm using those levels and either you get the reaction or you don't. In currencies, I tend to be a little bit longer term. So I'll give you an example. CAD yen, as you know, we're long this. 90.67. Let me scrunch this up. Give me a second here. There we go. So in CAD yen, I was indicating to clients the other day, if we get above 90.67, which is the upper green band, and if we get above 90.97, which is the upper purple band, I'm bullish. So I was already bullish for other reasons on CAD yen, so I took advantage of buying on the break above 90.67. And you might say, well, Dave, you just said use resistance to sell into. And I did say that. But in this case, there was an overall bullish tone to CAD yen. So I'm thinking, we get above 90.67 and hold, I want to be long. We get above 90.97 and hold, I want to be long. So I'm long at both of those prices, or right around those areas. And I'm hoping that if we can hold above 90.97, we've tried to get above 91.14, didn't really get there today. We go to 91.47, we get above here, then we're in kind of open territory. So I'm bullish CAD yen, but again, if we get back below, 90, if we get back below 90.97 and can't really get back above it, probably going to end up, pushing the trade. There's no reason for me to let it go all the way back to 90.67. When these levels get broken, you're expecting the reaction, kind of like what Peter Brandt talks about. If you're into a trade and you're a shorter term trader, whether it be intraday or even swing trader, you want that market to react to your entry pretty quickly, because if it doesn't, that means that nobody else gives a crap, at least at that point in time. So Rick, hopefully a couple of the emails I've had with you and this, the ability for me to kind of, discuss your question and the answers to it, help clarify things quite a bit. Again, trading is not formulaic. It's not A plus B equals C. Sometimes it is, very rarely. More times than not, it's A plus B minus C to the square root of Z, in some other funky math calculation. So, again, if you're just blindly buying and selling the support and resistance levels, you might be okay, but try to take into context what's happening in the overall market. There's times when you're thinking, when you say to yourself, you know what, I know this is a resistance level and I should be selling it here, but we can't seem to get below it. I'm going to be a buyer. And again, I'm just using that as an example. I'm not saying that you would necessarily do that, because I don't remember what was happening back on September 28th or October 4th. I don't remember what was happening back on that day. But what was obvious to me is that we kept testing this red level up in here, and we weren't immediately reacting lower, whereas before, at least here, immediately reacted lower. Not really much here either. So again, not clean. Nothing's ever perfect, but if you have these levels on your charts, and you can, if you have motive wave, this is motive wave, you can get the modules, Aspen Trading SR levels, or if you're on Trading View, you can get the module on Trading View as well and have these lines drawn on your charts so that you can look up any symbol you want. So Rick, how's that? That kind of address your question? Let me go through a few more symbols, and then we'll open up to some more Q&A. Again, I'm always going to focus on the S&Ps because I trade it, but more importantly, the S&Ps, they're kind of like the driver of markets in general. So it's been a bullish week in the S&Ps. Today was not a really good trading day, just a grind higher all day. And it was very, market was very robust in the overnight session, up about 20, 25 handles, which is quite unusual. But, it's hard to argue. If you're asking for my quote unquote back of the notebook or back of the matchbook assessment, 46.41, that's where we're going. We're above 45.14, we're above 45.35. Unless those levels come back and get tested. I've got smaller support in at 45.60. I want to see that hold on a short-term basis. But it wouldn't be surprised if we take a little bit of a breather, because what I can tell you about the tape today was we ground higher all day, but man, oh man, there was a lot of passive selling that just kept hitting the tape, but there was buyers there. There was a lot of passive buying, a lot of aggressive selling into the tape. Eventually that catches up. It either resolves itself and the sellers, kind of throw in the towel, or the buyer or the aggressive or the passive buyers, stop doing their passive buying, and then you get the tape to reverse. But right now, I'm not overthinking it. What I'm thinking right now, going into tomorrow's session in terms of the S&Ps, look to buy pullbacks, assuming that the tape is a little bit stronger. 45.60 will be an area. Obviously, if we get down into 45.35, 45.40, yeah, that's still a good level too. But I think we're going to 46.41. That, as of right now, that just seems like where we're going. The tape is very strong. Nasdaq's been strong as well. 10-year notes. I know most people maybe don't trade those, but you should consider them. It's a very, very good market to trade. Here's the 10-year notes. I mean, we're well below all sorts of levels in here. I can really only get bullish if we can get back above 127.10. Until then, I'll be looking to sell rallies into 127.10. We're in a new rate environment. Higher rates equals lower notes prices. So it's been tough for me to do anything in the last week or two in 10-year notes once we broke below here, which unfortunately I didn't grab, because again, after a big move like this, you're just thinking, geez, how much more can there be? But once we broke this 127.10 level, we just we kept moving lower. So for right now, if you're looking to trade 10-year notes, sell the rally into 127.10. However, if we get back above 127 and hold it, I really do think there's an opportunity to be long here because I think we go from one side of the 120, one side of the orange band all the way to 128.12. I would love to get almost 1.5 on 10-year notes. That would be a big, big trade. They move nice and slow. They don't whip you around like the S&Ps do. Rick, I'm glad. I'm glad that you're kind of getting the flow here. And again, just keep it at the most simple level. When you get the updates from me, draw the levels on the charts that you're looking at. Watch how prices react to them. Don't make it out any more than that. We tend to, as individuals, overcomplicate trading. Trading does not need to be complicated. The best traders I've ever seen in the over the years don't have a whole lot going on their charts. They've got their one analysis approach, and that's it. If you've got to explain to somebody why you're going to take a trade and you can't do it in less than 10 or 15 seconds, you don't know why you're taking the trade. You don't have a clearly defined strategy. For me, it's very clearly defined. It's all based on support and resistance. If we're hitting resistance, I'm looking to fade that. If we're hitting support, I'm looking to fade that until proven otherwise. Sounds easy, and sometimes it is easy, but there's other things you have to factor in: fear and greed. What's the market dynamics? It's all stuff like that. So we got 10-year notes, went through Aussie Dollar, we did CAD Yen, we did the S&Ps. Any stocks that you guys may want to see, I'm happy to look at a few. Those are the primary ones that I trade. Euro, oh, here's a good one. Here's one we got short. We got short. Look at that again. Purple line. Resistance is resistance until proven otherwise. This was from last Thursday or Friday. Actually, I guess I would know what day it was. No, it was Monday. But we went short on Friday. That's what it was. It was last Friday. I want to short into this 84.72 level. No, not too shabby. We can get back below 84.33 and close below there tomorrow. Great. Then we're going down to 83.89. I am short from up here. I had a partial stop at 84.50, which came back and got triggered today, but I'm still long or still short a portion of this position. So again, you don't have to be a skilled trader to know that, purple level. Dave told me that's the most significant. Prices are coming up after a big rally, so maybe they're running out of steam. Remember the marathon example. Why don't I get short here? And where's your stop if you're wrong? You get short around 84.60, 84.70. If prices close up here and they look really firm, 10, 20 pips, whoopee-doo. That's where your stop is. But more times than not, the market's going to respect these levels. Look at how many times this purple level has been respected. All the way back to April. Boom, boom. A little whip through, back through. I mean, then it started getting really, really messy, I guess, but from a trading perspective, quite good. And even on the upside, a little messy, a little bit of a hit, not quite a hit. I mean, these levels work. Again, not drawn after the fact. So that's Euro Sterling. But yeah, let me know what else you guys might want to see. And if not, we're just going to wrap it up. And I've told you what I'm thinking about for the S&Ps. Told you what I think about Aussie Dollar. And gave you CAD Yen, which I like, Euro Sterling. What else we got here? I'm looking at my quote board right now. We went over Tesla. Oh, ARK. ARK could be interesting. Things been so beaten down like so badly. But signs of life here. Signs of life. We got back above resistance. Again, the upper green band. You can see the green and the orange are kind of overlapping a little bit here. Had a nice close today above 75.21. Is that correct? Can't see that level. Anyways, right in here. Yeah, 75.21. Closed at 76.11. We hold here. Guess where we're going? 88.31. I'm sorry, 83.81, and maybe back to this massive level that we called. This was back. Anybody who's on this, it was a client in December, knew exactly what to do in early January. I said, if we break 89.40 or 89.50, I think it was actually 89.60 if you line up my cursor properly. We go below 89.60, lights out for ARK, and it was lights out. It just went straight down. And again, that was the lower red band. The upper red band is here. And you might say, well, Dave, you said support is support. And I always have the qualifier. until proven otherwise. Support, rally, support, rally, support, S&Ps and NASDAQ getting clocked into the beginning of the year, a very weak tape. Sell that break, sell that break. That's the time where support now becomes resistance. It did come back, hit it one more time back on January 12th, and right back down. So if you missed this initial thrust, you got another look at it. And if you didn't sell that there, if you're a stock trader and you trade ARK, shame on you, because your stop loss was a couple of bucks and you knew what the downside was. It was empty space down there. These levels weren't here at that time. But in early January, it was empty down here. So that's how you use the support and resistance levels. They're simple, they're ingenious, and they freaking work. So yeah, I'm passionate about it. They're my creation. Of course I'm passionate about it, and I use them in my trading every day. I trade the S&Ps religiously off these levels. I trade everything off these levels. I only trade a handful of instruments, as you folks know, but I trade it all based on the levels, and it's what works for me. The nice thing is I'm not spending hours upon hours after the market close scrolling through charts, looking for setups, doing a lot of analysis that maybe, as I said at the beginning, nobody else gives a rip about. And if nobody else in the marketplace gives a rip, the movement that you're looking for has a lower probability of playing out. It's that simple. It's really that simple. So that's all we got. No other questions. I do appreciate everybody popping in. If you have not taken a trial to the daily market forecast, and this is, no, I don't have a copy of it up, sorry. But if you have, I know the folks at Eightcap sent out a email to sign up for a 2-week trial. We're also doing a promo right now. If you like what you see on the daily market forecast, you can get a year for $250. Normally it's $49 a month, so it's a pretty big savings. It's our entry-level product. It's not going to give you everything you need, but it's going to give you the basic building blocks of the key levels that you want to be looking for. So as always, the folks at Eightcap, you guys are wonderful to work with. Great team. You guys are in good hands. Everybody who has accounts there, but you guys already know that. I greatly appreciate it. I'll be back with another video on Sunday, and we'll meet back here again, same time next Wednesday, or for those in the Asia area, next Thursday morning. So thank you so much. Everybody have a wonderful day, wonderful evening, regardless of where you are in the world. Take care now. Bye-bye now.